Good evening. This side, Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multinational headquartered group based out Singapore. We are a multinational hedge fund and multi-asset hedge fund who actively take positions in US, Europe, and Asia. We take positions in multiple asset classes, which includes equity, currencies, commodity, and many more asset classes. But like I repeated many times, we are a proprietary hedge fund. By proprietary, I mean no third party. I repeat, no third party can invest capital in our fund. When we speak about F&O, which is future and options, be it any country, whether it is United States, it is Europe, or any country, there are four kind of people we have in F&O market. Number one are the vertical traders. Vertical traders are those people who play on the strike rate. They keep the expiration same while they play on the strike rate. Example, the range forward. Range forward, the expiration or maturity is intact while the strike differs. Range forward is a vertical trade. Second kind of player are those players who are horizontal traders. Horizontal traders are those traders who play on expiration, which means they keep the strike intact while they play on expiration. So like we are shooting this video in August 2022, it practically means one leg would be in August 2022 while other leg would be in September 2022, maybe more. Third is the diagonal traders. Diagonal traders are those traders who not only play on the strike rate, but they do play on the expiration also. So which means like we are shooting in August, they play on the strike rates. It means the strike rates would differ. So would be the expiration. If you are an F&O person, be it any country of the globe, please do understand very clearly, are you a vertical trader whose USP means unique selling proposition is the expiration is the strike price? Are you a horizontal trader whose USP unique selling proposition is the expiration? Or are you a diagonal trader whose USP is not only the strike price but also the expiration? This is something you would like to understand very holistically and clearly. In the last few months, the F&O space is coming up with new set of breed. And this breed is little bit wealthy. It means they are those people who have huge capital and they can take a risk. And the name of that breed is the synthetic traders. Synthetic traders are those traders, those who keep the expiration intact, just like vertical traders, but their strike price is also the same. So they keep the expiration intact while the strike price is also the same. One of the categories of synthetic traders is the straddle. Whether you are going long straddle or you are going short straddle. But unfortunately, straddle, practically speaking, cannot be considered as 100% synthetic trade, because straddle can be vertical also. Like I repeated many a times, options is an art, it is not a science. Science means hard and fast rules, and art means you devise according to the requirement. Options is an art, it is not a science. I have noticed that there are many people who are emerging up in the market on Twitter, on LinkedIn, and various platforms, and their strategies are more or like synthetic strategies. Now let me bifurcate something. If I speak in terms of capital allocation, then vertical traders need less capital as compared to horizontal traders, as compared to diagonal traders. In all these three, vertical, horizontal, and diagonal traders needs the highest capital, as we can say. But synthetic traders needs much beyond expectations. So if a diagonal trader who not only plays at expiration, but he's playing at strike price also, if he needs a capital of $100 or 100 rupees or 100 euro or 100 yen, in this eventuality, the synthetic trader might need $200, $300, and probably more. The risk a synthetic trader is carrying is much more than even a diagonal trader is carrying. So let me repeat. In terms of capital allocation, the vertical trade have less capital requirement. Horizontal trade have more capital requirement. Diagonal trade have the highest capital requirement, while the synthetic trades have huge capital requirements. While in terms of risk, the highest risk is faced up reverse by the synthetic traders, followed by the diagonal traders, followed by the horizontal traders, and the last is the vertical traders. So if you are working in F&O segment, be it any asset class, whether this is equities, this is gold, this is silver, probably any ETF, it would be better you sit coolly, take a piece of paper and decide you are which part of the F&O. Please don't try to be a diagonal trader without having expertise in your hand. Because if you're trying to be a diagonal trader without having expertise in your hand, it's like jumping into the sea without knowing much about the swimming. Rest is your call. Personally speaking, I am a vertical trader and I am a diagonal trader. So 90% when I take F&O, I am vertical, and 10% I am diagonal, but rarely I am horizontal. But I am not synthetic because it requires a huge capital and the risk is really very high. This is what I would like to convey. This is Rahul Magan.